I welcome you all to Module 3 of Month 2 of this mentorship. This is going to be like a part 2, a continuation of the last lecture I gave you concerning equilibrium and discount. So we're going to talk about equilibrium versus premium. This session is not going to be too long because we've already discussed it in the previous video. I'll only be filling in the gaps in this lecture. So like I said before, a significant price range is formed when the buy side and the sell side have not been taken. What you want to do is to map out your range, divide it into two, with the equilibrium price being the midpoint. And then above the equilibrium price is the premium, and then below the equilibrium price is a discount. But in this lecture, I'm going to be explaining how you can implement it in a trade setup. Now look at how price ran down swiftly to this point, and then began to rally upwards. Take a look at price at equilibrium. Like I mentioned before, price tends to consolidate at equilibrium. When price is at equilibrium in a range, you want to sit on your hands because you would see that price consolidates and doesn't move. You want to make money. You want to trade the market when market is moving. So what you do is to wait for market to either go to premium or discount before you take a trade. So you can see how price was consolidating at equilibrium. Equilibrium tends to serve as a magnet for price, like I've always been saying. You can see how price told at this point. This is fair value, neither expensive nor cheap. Now price ran into premium. And then look at what happened. Price began to break down. Now once price breaks down, it has broken what? A low after taking out liquidity. This place, as you can see here, is liquidity. Let me draw it out. So here, market took this high, then broke down to break this low, forming a break of structure. So we would expect the market wants to go down because why? This is a premium. So you want to sell in a premium and you want to buy in a discount. It's just very simple. If you have a product, you don't want to sell it when it is cheap. You want to sell it when it's expensive. And look at here, price is at a premium. You want to sell it when it's expensive. But I want to explain something to us again. What makes it expensive and what makes it cheap? So just to be clear, according to the market makers, when market rallies down like this, when market rallies downwards, they expect that price would return back into the range. And if they wish to sell the market downwards, they will not sell here because it's within this range, the market is still at discount. They want market to go upwards. They want market to rally into the premium that is overbought. They want people to think that market is rallying. So this will bring an influx of buyers and to create liquidity for the market makers because they can't execute their large orders if there is no liquidity. So they need this influx of buyers so that they can sell to, because if they try to sell when there are no buyers, their order will not be executed. So what happens? They want market, because if price moves up, down, only few people will think that the market is bullish after making this huge range. But by the time price moves higher into the premium and then continues to move higher, many traders will see this over time and think that price is going higher. So what happens? They tend to buy. And not just that, as market rallies, it begins to form liquidity. What do you think will be under this low? Stop orders. What do you think will be under this low as well? Stop orders. So it will be creating liquidity as it rallies into the premium. The moment market gets into premium, where it is now expensive, the market makers tend to sell to grab those liquidity. Now, presently, the market is here. After running upwards, it broke down, retraced, then ran the liquidity that is here. So I look forward to price running down into this liquidity, into a discount. And then here, before running down this low. It might not happen, but we use this concept to form a trade setup. Now, I want to show us a model we can also use while trading the price range using the Fibonacci. Now, look at what happened here. Market got to a premium, deep premium, not just premium, but deep premium. Like I told you before, you can further divide your premium into discount and premium. Let me show you. So from here to here, is a premium. So you can further divide it. This point becomes premium. This point becomes discount. Where do you think market is at this point? It is at deep premium. So it is overbought. Now, once market takes out liquidity and breaks structure, look at here, there's a break of structure. Let me just take out this thing so that we'll see clearly. If you look closely, I think I should enlarge it so that we'll see it. If you look closely here, it took out liquidity here, and then reversed to what? Break structure here. Now, once it breaks structure, we expect that market should retrace into this range that was formed. If you look at it here, actually it came down here. Let me just clean it. It actually came down here and broke structure. So we're anticipating market to retrace into this range that has been formed for a continual downward into the discount, because we want to sell at premium and buy at discount, or come out of the trade at discount. I hope you understand. So now, if you take your fib and you draw it from this high here to this low, this box that I outlined here marks the beginning of our premium from this range, from here to here. So this is the premium relative to this range, newly formed range here. This is the premium. And this whole price action is happening where? In the premium of the parent range. I hope you understand. We should get this now. So after drawing our fee, what happens? Market retreats into premium. And not just premium. What do you think this is? This last up close candle before the down move. That is the last up close candle before a down move. What is this? Another block. Now there's also something that you can also see here. Can you tell me what it is? A fair value gap. So we combine this reference point with equilibrium and premium, because we can see that this box marks the beginning of a premium. So from here to this point is a premium. Market went into premium, finding resistance in this other block, and also filling in this sell side inefficiency, fair value gap. So another thing we can also do is to refine the trade, because now we're expecting that price should be bearish. Why? Because this move here, this rally has taken out liquidity. After taking out liquidity, it came down to break structure below the market. And this is happening in a premium. And in a premium, what do? We sell. So now we expect what? Price to be bearish from this point to take out liquidity below the market, entering into discount. We'll also take out a trade. So what we can do is to go down to a lower time frame and refine this area to see how we can further get a trade set up. So now let's go down to the lower time frame. So that red box you saw in the previous slide is this that you see here. This is it. So I went down to a lower time frame. That was a day time frame. This is a 4-hour time frame. Now look at it here. We can further refine the trade, because if you draw a fib from this high to this low, because this high has taken out liquidity and then broke structure here. So we expect that price to reverse. We don't want to chase this price. You don't need to chase it. You wait for it to reverse back into the range, and don't just reverse into the range. You want to reverse it. You want it to reverse deep into premium of this range. And you can trust that market will want to go down, because all this price action is happening in a premium relative to the parent range. All right. Now look at how price broke down, breaking structure here. Then price retraced back into where? This whole range that was formed inside the red box. So you can take a trade from this point here and write it down to take out liquidity and then fill this void. Market presently is still at premium, so we expect a continuation down into discount. So let me refine this so that we can see it clearly. So that box we saw earlier, this is it. So we can see how market rallied down, broke structure, and then reversed back into this price range. Now, price doesn't just reverse back into the price range. What do you see here? Look at it. From this candle here to this candle here, there's a fair value gap. So price filled in the fair value gap and the rally downwards to take out liquidity. So one thing we can do is that when we draw our fib on a higher time frame, and we expect that price should rally from that point downwards, maybe in a premium or in a discount. We can further refine it by going down to a smaller time frame to draw a fib again. And what we want to see is we want to see a break of structure. Break of structure tells us that market wants to go in that direction, because as market moves this way, we know that the market makers are coming into the market to take market lower. Now, here's another way we can also implement the price range using the premium versus equilibrium. So we can see here from this high to this low, price form the range. And then if you take your fib from this high to this low, dividing into two, the midpoint is the equilibrium price, above is premium, below is discount. Now, one very important thing we should know is that when sell stops are taken in the discount, expect price to rally into the premium. And when buy stops are taken in the premium, expect price to rally into the discount. Now, look at how price went from this low, ran into what? Premium, retraced, took this high, and then went back to fill in this fair value gap inside the discount. Market rallied again, took out liquidity, because the market is taking out liquidity in a premium. We are expecting it to rally into the discount. Now, look at how it took out this liquidity here. And not just that, it went and found, it went into this order block, the last up candle before the down move. Look at it here. I'm sure we can see it clearly. Market found resistance at this point and then rallied downwards. Take out sell side liquidity inside the discount. After taking out sell side liquidity, market ran back up again into premium to take another liquidity. We can trust that this bearish order block we hold because it is at a premium. So we expect it to hold price downwards into the discount. Are you seeing it now? So we can combine reference point to take trade in a price range, because price has been ranging for a very long time. This is a daily time frame. Look at how price has been ranging for a very long time, and then price began to trade inside this range. So what you have to do is, you don't have to wait for a trend to begin before you start taking a trade. What you do is to map out your trade and then expect to sell when the market is above equilibrium, that is in the premium, and then buy when the market is below equilibrium, that is discount. And then look at how price moved. I will come again. Price moved up, creating a fair value. Now, I explained before that there was only selling here and then buying. So this range is closed. And this place is open because there was only buying occurring here. Here we can see the selling to close it. But market rallied up, took out liquidity, then rallied downward to close the fair value gap. After running downwards, it found support and then rallied upwards into premium, and then took out liquidity, finding resistance at this other block, then rallied downwards again to clear out sell side liquidity in the discount. After clearing out liquidity, it rallied back upwards to clear out liquidity in the premium. Now, once market clears out liquidity in the premium, it supports a bearish bias into the discount. You can trust that when liquidity is taken in the premium, market should rally downward into the discount. Now, it doesn't happen perfectly all the time. Now, market is not perfect. There are times you might lose trade. It doesn't just happen like that. There are other things you will blend and combine together, because there are times you're going to lose trade. Don't avoid losing trades. It's okay to lose trades. Now, look at what happened here. Liquidity was taken here. Let me just draw it out. This high, market took out liquidity. So after market took out this liquidity here, market ran down into discount, a little bit into discount, and then rallied up. So let's say you held this trade for a longer time, you'd have been taken out by this rally upwards. You lose the trade, but that doesn't stop you from entering the market again. You're going to lose trades, guys. Don't avoid it. If you try to avoid it, you will end up ruining your career as a trader. All you need to do is to manage risks. Manage the amount of money you risk. Don't just risk all your account. You risk a particular percentage of your account. You're going to lose money. Let it get into your head. It's normal to lose money in trading. It's absolutely normal. That's why there's need for risk management. So let's say the market took you out at this point. What happens? It took another liquidity here again. You enter again for a sell. And look at how price ran beautifully into this fair value gap. So if you sell, you should be taking out your profit at a fair value in a discount. And if you buy, you should be taking out the profit at a fair value and a discount. So it is just very simple. And don't worry, I'm going to give a lecture on fair value. We're going to see what the fair value actually is. All right. So you can expect that this order block should hold. Because why? It is a bearish order block and it is in a premium. Bearish premium. Bearish means price should go down. You should expect bullish order blocks to hold at a discount. So you can see bullish order blocks here. They should hold at a discount. Why bearish order blocks should hold at a premium. So we can see it here. You can see bearish order block holding in these 2 points. Okay. So to further explain the concept, you can see this high here. Market took the liquidity and then rallied downwards. This high too, market took our liquidity in a premium and then rallied downwards. This is where we are currently in the Euro USD. So I expect market to run down, take out this liquidity, and then take out this liquidity before taking out this liquidity, because we can see that the trend is being created inside this range. Now, I may be wrong, but this is what I think will happen. So once again, I wish you all good luck and good trading.